In 2008, the global economy stood on the brink of collapse. The culprit? America's banks. Yet instead of falling, they emerged more powerful than ever. This wasn't an accident. It was the culmination of a 250-year journey, a story of ambition, innovation, crisis, and control. Today, just 4 banks control nearly half of all American banking assets. They influence elections, shape policy, and hold the economic fate of millions in their hands. But how did we get here? This is the story of the rise of banks in America, from humble colonial beginnings to an empire that some say is too powerful to fail and too powerful to stop. Colonial America, 1750s. If you wanted to buy land, start a business, or even purchase basic goods, you faced a problem: there was almost no money. Images of colonial settlements, barter systems. The colonies operated on a chaotic patchwork of currency: British pounds, Spanish dollars, tobacco notes, and even wampum beads. But the British Crown, fearing competition with the Bank of England, strictly limited the colonies' ability to print their own money or establish banks. This wasn't just inconvenient. It was suffocating economic growth and breeding resentment that would eventually fuel revolution. December 31, 1781. Robert Morris, the superintendent of finance for the Continental Congress, chartered the Bank of North America in Philadelphia. It was America's first true bank, but it was born from desperation. The Revolutionary War was bleeding the new nation dry. Soldiers went unpaid. Supplies ran short. The continental dollar had become worthless, literally not worth a continental. Morris saw a bank as the solution, a stable institution that could provide credit, manage government accounts, and restore confidence in American currency. The Bank of North America was controversial from day one. Was it constitutional? Did it give too much power to wealthy merchants? These questions would echo through American history for the next 2 centuries. Alexander Hamilton's bold vision. Enter Alexander Hamilton, perhaps the most consequential figure in American financial history. Portrait of Hamilton, images of early New York. As the first Secretary of the Treasury, Hamilton faced a nightmare: the new nation was drowning in debt from the Revolutionary War. States were printing their own currencies. There was no unified financial system. Hamilton's solution was radical for its time. In 1791, he proposed the first Bank of the United States, a central bank that would be partially owned by the federal government but operated by private investors. It would have a 20-year charter, enormous capital of $10 million, and branches across the nation. The opposition was fierce. Thomas Jefferson and James Madison argued it was unconstitutional. The Constitution didn't explicitly grant Congress the power to create a bank. They feared it would consolidate power in the hands of wealthy elites and create a financial aristocracy. Hamilton countered with his doctrine of implied powers. The Constitution granted Congress power to do what was necessary and proper to execute its duties. Managing the nation's finances required a bank. President Washington sided with Hamilton. The first Bank of the United States was born. For 20 years, the first bank functioned remarkably well. It stabilized currency, provided credit for infrastructure projects, and managed government debt. But it made enemies. Western farmers and Southern plantation owners despised it. They felt it served Northern merchants and financial elites while restricting credit to rural Americans. State-chartered banks hated the competition. And political opposition, led by Jeffersonian Democrats, saw it as a betrayal of Republican ideals. When the bank's charter came up for renewal in 1811, Congress voted it down by a single vote. America's first experiment with centralized banking was over. The consequences were immediate and catastrophic. Between 1811 and 1816, America descended into financial chaos. The War of 1812 proved nearly impossible to finance. State banks proliferated wildly, each printing its own notes with little backing. Counterfeiting became rampant. A merchant in Boston might refuse currency from a Baltimore bank. Economic growth sputtered. Even opponents of the first bank began to admit, maybe Hamilton was right. In 1816, Congress chartered the Second Bank of the United States, essentially a recreation of Hamilton's vision, now with even more capital, $35 million. The Second Bank, headquartered in an imposing Greek Revival building in Philadelphia, became the most powerful financial institution in the nation. It held government deposits, regulated state banks by refusing questionable bank notes, and provided crucial stability to the economy. But it was also, in many ways, corrupt. The bank's early leadership was plagued by scandals. Insiders gave themselves preferential loans. Branches engaged in speculation. By 1819, mismanagement and aggressive contraction of credit triggered America's first major economic depression, the Panic of 1819. Thousands lost their farms. Unemployment soared. And Americans began asking, who really controlled this bank? Andrew Jackson, war hero, populist, and perhaps the most famous bank hater in American history. Jackson saw the Second Bank as everything wrong with America, an unelected, unaccountable institution that served wealthy elites at the expense of common people. He called it the Monster Bank and made its destruction his mission. Nicholas Biddle, the aristocratic president of the Second Bank, was the perfect villain for Jackson's narrative. Biddle was brilliant, arrogant, and openly contemptuous of democratic politics. He once wrote that the bank ought to be independent of the government. This was exactly the wrong thing to say to Andrew Jackson. The conflict came to a head in 1832. The bank's charter wasn't set to expire until 1836, but Biddle made a fatal miscalculation. He applied for early renewal, hoping to make it an election issue. Jackson vetoed the renewal in a message that became one of the most famous documents in American political history. He called the bank unconstitutional, un-American, and a threat to democracy. It is to be regretted that the rich and powerful too often bend the axe of government to their selfish purposes. Jackson won re-election in a landslide. But he wasn't done. In 1833, he ordered the removal of all federal deposits from the bank and redistributed them to state banks, what his opponents called pet banks. Biddle fought back by contracting credit, triggering a recession. He intended to pressure Congress into saving the bank. Instead, he proved Jackson's point: the bank had too much power. When the charter expired in 1836, it was not renewed. America would not have another central bank for 77 years. Jackson's victory seemed like a triumph for democracy. But the consequences were severe. Without federal oversight, state banks exploded in number, from 330 in 1830 to over 900 by 1840. Many were wildcat banks, so named because they were located in remote areas where only wildcats lived, making redemption of their notes nearly impossible. Economic instability became the norm. Banking panics occurred in 1837, 1857, 1873, 1884, 1893, and 1907. Each crisis destroyed fortunes, businesses, and lives. Yet out of this chaos, something unexpected happened. A new class of financial titans began to rise. The mid-19th century saw the emergence of a new kind of power in American finance, the private banking house. Without a central bank, a handful of private bankers stepped into the void. They financed railroads, factories, and infrastructure. They managed government debt. They became, in essence, private central banks. The most powerful of these were German Jewish immigrants who brought European banking expertise to America: August Belmont, the Seligmans, the Lehmans, and above all, the House of Morgan. J.P. Morgan, the man who was the central bank John Pierpont Morgan, was born into privilege in 1837. His father, Junius Morgan, was a successful London banker. Young Pierpont was groomed for greatness from birth. But Morgan was more than just a rich man's son. He had an almost supernatural ability to assess risk, structure deals, and inspire confidence. By the 1880s, J.P. Morgan and Company had become the most powerful bank in America, and perhaps the world. Morgan didn't just lend money. He reorganized entire industries. When railroads went bankrupt, and many did, Morgan restructured them, often taking board seats and installing his own management. This process, called Morganization, consolidated the chaotic rail industry into efficient, profitable systems. But it also concentrated enormous power in Morgan's hands. October 1907. The Knickerbocker Trust Company, one of New York's largest financial institutions, collapsed. Panic spread through the financial system like wildfire. Depositors rushed to withdraw their money. Banks called in loans. The stock market plunged. America was hours away from complete financial collapse. The federal government was helpless. There was no central bank, no Federal Reserve, no emergency procedures. There was only J.P. Morgan. At 70 years old, Morgan took charge. He locked the city's leading bankers in his library and refused to let them leave until they pledged enough money to save failing institutions. He personally decided which banks would survive and which would fail. He strong-armed John D. Rockefeller into pledging millions. He convinced clergy to preach calm on Sunday. For 3 weeks, J.P. Morgan functioned as America's central bank. He succeeded. The panic subsided. But the episode revealed a troubling truth: the world's largest economy depended on one old man. By 1910, banking power in America had concentrated to an almost unimaginable degree. J.P. Morgan, George F. Baker of First National Bank, and James Stillman of National City Bank formed what was called the Money Trust, an informal alliance that controlled access to capital for the entire nation. In 1912, Congress launched an investigation led by Representative Arsène Pujol. The findings were shocking. These few men held 341 directorships in 112 corporations with aggregate resources of over $22 billion, more than all the property in the 22 states west of the Mississippi River combined. Morgan himself controlled railways representing more than 50,000 miles of track. His banks had interlocking directorates with virtually every major American corporation. When Morgan testified before the Pujol Committee, he was asked if commercial credit was based primarily on money or property. His response was revealing: "No, sir, the first thing is character. A man I do not trust could not get money from me on all the bonds in Christendom." It was an admission: the American economy ran on the personal judgment of a few powerful men. The Pujol Committee's findings generated public outrage. Progressives like Louis Brandeis wrote best-selling books condemning other people's money and how the bankers use it. Images of progressive-era reformers, protests. The concentration of financial power seemed fundamentally un-American. It violated democratic principles and created dangerous instability. Even conservative business leaders acknowledged that relying on J.P. Morgan to save the economy was not a sustainable system. Something had to change. But what emerged from this crisis would not weaken the banks. Instead, it would give them a new kind of power, one backed by the full force of the federal government. The end of World War II marked the beginning of American economic dominance, and with it, the dominance of American banks. The Bretton Woods Agreement of 1944 established the dollar as the world's reserve currency. American banks financed the reconstruction of Europe and Japan. They funded the suburban housing boom, the interstate highway system, and the rise of corporate America. Banks became boring and profitable. Strictly regulated under the Glass-Steagall Act, commercial banks took deposits and made loans, while investment banks underwrote securities. It was a stable, predictable system. But stable systems breed complacency. And complacency breeds revolution. 1958, Bank of America launched the first modern credit card with revolving credit, the Bank AmeriCard, later renamed Visa. It seemed like a convenience, a way to make shopping easier. But it was actually a revolution in banking business models. Before credit cards, banks made money primarily from the spread between deposit interest and loan interest. Credit cards added new revenue streams: merchant fees, annual fees, and, most lucratively, interest on revolving balances. American Express, Diners Club, and eventually MasterCard followed. By the 1980s, credit cards generated more profit than traditional lending for many banks. Consumer debt exploded, from $56 billion in 1960 to over $4 trillion today. Banks had discovered something powerful. Ordinary Americans could be as profitable as corporations, if you could get them to borrow continuously. By the 1970s, the post-war banking model was straining under new pressures. Inflation soared. Interest rate caps on deposits, imposed by Regulation Q, meant banks couldn't compete with new money market funds. Foreign banks, unrestricted by Glass-Steagall, were eating into American banks' market share abroad. The banking industry lobbied hard. Regulations designed for the 1930s, they argued, couldn't handle the 1970s. They needed freedom to compete, to innovate, to serve customers better. It was a compelling argument. It was also the beginning of a transformation that would concentrate more power in banks than even J.P. Morgan could have imagined. But first, a warning of what deregulation could mean. Savings and loan institutions, community banks that financed home mortgages, were deregulated in the early 1980s. Suddenly able to make riskier investments, many SNLs went on wild sprees: speculative real estate, junk bonds, even casinos. Charles Keating's Lincoln Savings and Loan epitomized the excess. He spent lavishly on political influence. 5 senators, the Keating Five, intervened with regulators on his behalf. His institution eventually collapsed, costing taxpayers $3 billion. By 1989, over 1,000 SNLs had failed. The bailout cost taxpayers more than $130 billion. It was, at the time, the most expensive financial disaster in American history. It wouldn't hold that record for long. November 1999. President Bill Clinton signed the Gramm-Leach-Bliley Act, officially repealing the Glass-Steagall Act that had separated commercial and investment banking since 1933. The separation between commercial banking, taking deposits and making loans, and investment banking, underwriting securities and trading, was gone. Banks could now do everything. Proponents argued this would make American banks more competitive globally and create efficiencies. Senator Phil Gramm declared it would better enable American companies to compete in the new economy. Critics warned it would recreate the conflicts of interest and excessive risk-taking that caused the Great Depression. Senator Byron Dorgan predicted, "I think we will look back in 10 years' time and say we should not have done this." He was off by 1 year. The merger mania of the late 1990s and early 2000s saw an unprecedented wave of bank mergers. Chemical Bank merged with Chase Manhattan. Bank of America acquired Nations Bank. Citicorp merged with Travelers Group to form Citigroup, a merger technically illegal until Glass-Steagall was repealed. J.P. Morgan merged with Chase. Wells Fargo acquired Norwest, then Wachovia. Each merger was sold as creating efficiency and better service. In reality, branches closed, fees increased, and local relationships were replaced by call centers. By 2008, the 4 largest banks, J.P. Morgan Chase, Bank of America, Citigroup, and Wells Fargo, controlled 39% of all deposits. Today, that figure is nearly 50%. The mega banks had achieved something remarkable. They had become essential infrastructure. They weren't just banks anymore. They were market makers, payment processors, custodians of retirement accounts, credit card networks, and investment platforms. They were so interconnected with the global economy that their failure would trigger systemic collapse. They had become, in the words of regulators, too big to fail. Bank executives understood this perfectly. It gave them implicit government backing, a free insurance policy. They could take bigger risks, knowing that if things went wrong, taxpayers would have to save them. It was moral hazard on a civilizational scale. And it was about to be tested. In the early 2000s, America experienced the largest housing bubble in its history. Images of suburban developments, for sale signs. Home prices doubled in many markets. Mortgages were given to people with no income verification, so-called ninja loans, no income, no job, no assets. Predatory lenders targeted vulnerable communities, particularly minorities, with subprime loans featuring hidden fees and exploding interest rates. Why would banks make loans they knew borrowers couldn't repay? Because they weren't holding the loans. Wall Street had invented a new alchemy. Banks would originate thousands of mortgages, bundle them together, and sell them as securities to investors worldwide. This process, securitization, seemed brilliant. It spread risk, provided liquidity, and freed up banks to make more loans. But it broke the oldest rule in banking: if you don't hold the loan, you don't care if it's repaid. Mortgage brokers were paid on volume, not quality. They had every incentive to make as many loans as possible, regardless of borrower ability to repay. The banks that bought these mortgages only held them briefly before securitizing them. Rating agencies, paid by the banks, gave AAA ratings to securities that were fundamentally junk. Everyone in the chain made money. And everyone assumed someone else was managing the risk. They were wrong. The crisis began quietly in 2006 when housing prices stopped rising. Then they started falling. Borrowers with adjustable-rate mortgages saw their payments spike. They couldn't refinance because their homes were now worth less than their loans. Defaults began, slowly at first, then accelerating. By 2007, the securities backed by these mortgages were collapsing in value. Bear Stearns, one of Wall Street's most prestigious investment banks, saw 2 hedge funds implode. The contagion spread globally. These toxic securities had been sold to banks, pension funds, and investors everywhere. March 2008, Bear Stearns collapsed and was sold to J.P. Morgan for $2 a share, a company that had been worth $170 a share the year before. September 2008, Lehman Brothers, a 158-year-old institution, filed for bankruptcy, the largest bankruptcy in American history. The global financial system froze. The government faced an impossible choice: let the banks fail and risk another Great Depression, or bail them out and reward the very people who caused the crisis. The Troubled Asset Relief Program, TARP, injected $700 billion into the financial system. The Federal Reserve took unprecedented actions, buying mortgage-backed securities, extending emergency loans, and cutting interest rates to near zero. In total, the bailout, guarantees, and interventions totaled over $12 trillion in various forms. The banks survived. But 8.7 million Americans lost their jobs. 10 million lost their homes. Middle-class wealth evaporated. And the banks? Within a few years, they were larger and more profitable than ever. One of the great ironies of the 2008 crisis is that it made banks more concentrated, not less. During the crisis, troubled banks were absorbed by stronger ones, often at government behest. Bank of America acquired Merrill Lynch and Countrywide. Wells Fargo absorbed Wachovia. J.P. Morgan took over Washington Mutual and Bear Stearns. The megabanks emerged from the crisis with greater market share, less competition, and an even clearer too-big-to-fail guarantee. Jamie Dimon, CEO of J.P. Morgan Chase, stated it plainly: "I don't think anyone realized the degree to which banks would be consolidated." But he knew. And he benefited enormously. In 2010, Congress passed the Dodd-Frank Wall Street Reform and Consumer Protection Act, the most comprehensive financial regulation since the 1930s. The law created the Consumer Financial Protection Bureau, imposed capital requirements, and established the Volcker Rule prohibiting proprietary trading by commercial banks. Banks hated it. They spent millions lobbying against it, watering down provisions, and delaying implementation. They argued it would restrict lending and hurt economic growth. But did it actually constrain them? Capital requirements forced banks to hold more reserves, but those reserves could include things like deferred tax assets and mortgage servicing rights. The Volcker Rule had so many exemptions that banks found creative ways around it. And too big to fail wasn't solved. It was institutionalized through living wills and resolution plans that no one truly believed would work. Many provisions of Dodd-Frank were later rolled back under the Trump administration. While regulators fought the last war, banks were transforming themselves through technology. Physical branches declined. Mobile banking exploded. Algorithms replaced loan officers in assessing creditworthiness. High-frequency trading, conducted by bank subsidiaries, came to dominate stock markets. Banks also faced new competition from fintech companies, PayPal, Venmo, Square, and cryptocurrency platforms promised to disrupt traditional banking. But the mega banks adapted. They bought fintech startups, partnered with technology companies, and poured billions into their own digital platforms. Their scale, regulatory expertise, and access to capital proved advantages that startups couldn't match. Far from being disrupted, banks absorbed the disruption and became more powerful. Perhaps the bank's greatest strength isn't their balance sheets, it's their political power. The financial sector spends more on lobbying than any other industry, over $2 billion between 2008 and 2020 alone. Banks employ armies of former regulators, congressional staffers, and Treasury officials who understand policy intimately and know whom to influence. Campaign contributions flow to both parties. Goldman Sachs executives have served as Treasury Secretary under both Democratic and Republican administrations. The revolving door between Wall Street and Washington spins faster than ever. This isn't a conspiracy. It's something more subtle and more powerful: regulatory capture. The banks don't need to bribe officials. They provide expertise, fund think tanks, and create a policy ecosystem where banking interests and national interests become indistinguishable. When bank executives say, "What's good for our bank is good for America," they genuinely believe it. So do many policymakers. Today, four banks dominate American finance with assets totaling over $9 trillion. J.P. Morgan Chase, $3.7 trillion in assets. The largest bank in America, touching nearly every aspect of finance. Bank of America, $3.1 trillion. The nation's largest mortgage lender and one of the largest credit card issuers. Wells Fargo, $1.9 trillion. Despite massive scandals, including creating millions of fake accounts, it remains a financial giant. Citigroup, $2.3 trillion. The most global of American banks, operating in over 100 countries. Together, these four institutions hold nearly half of all banking assets, process the majority of credit card transactions, provide most mortgages, dominate corporate lending, control access to capital markets for businesses, manage most Americans' retirement accounts. They are gatekeepers to the American economy. Yet their track record since 2008 has been troubling. Wells Fargo created over 3.5 million fake accounts to meet sales targets, charging customers for services they never authorized. Fined $3 billion. J.P. Morgan manipulated precious metals markets for years. Fined $920 million. Bank of America misled investors about mortgage-backed securities. Fined $16.65 billion. Goldman Sachs helped Malaysia's 1MDB fund embezzle billions. Fined $2.9 billion. Deutsche Bank, HSBC, and others were caught laundering money for drug cartels and terrorists. The fines sound enormous, until you realize they're often a fraction of profits from the illegal activity. No senior executives went to prison for these crimes. Instead, banks admitted wrongdoing, paid fines with shareholders' money, and moved on. The pattern is clear: crime, fine, repeat. March 2020. The COVID-19 pandemic triggered economic shutdown. Once again, the Federal Reserve rode to the rescue. The Fed cut rates to zero, launched unlimited quantitative easing, and created emergency lending facilities, including buying corporate bonds, something it had never done before. Banks were intermediaries for the Paycheck Protection Program, earning billions in fees for processing government loans. They benefited from Fed interventions that inflated asset prices. Their stock prices recovered within months while Main Street struggled. When the economy faces crisis, the pattern is consistent: socialize the losses, privatize the gains. Bitcoin and cryptocurrency promised to disrupt banking, peer-to-peer money that needed no intermediaries. Initially, banks dismissed crypto as a fad or a scam. But as cryptocurrencies gained value and popularity, their tune changed. Now banks offer crypto custody services, invest in blockchain technology, and lobby for regulations that would benefit them while limiting true decentralization. Central banks are developing their own digital currencies, which would give them even more control over the money supply and transactions. The pattern repeats: financial innovation emerges, threatens banks, then is absorbed by them. Looking forward, banks face both challenges and opportunities. Climate change will reshape lending and investment. Artificial intelligence will automate more services. Digital currencies may transform payment systems. New regulations could emerge, or be gutted. But one thing seems certain: the mega banks are not going away. They're too large, too interconnected, and too politically powerful. They've survived every crisis in American history, often emerging stronger. The question isn't whether banks will be powerful in the future. The question is, who really controls them? From Alexander Hamilton's first bank to today's trillion-dollar mega banks, American banking has been a story of innovation, crisis, and consolidation. Banks financed the westward expansion, the Industrial Revolution, 2 world wars, and the technological age. They've enabled millions to buy homes, start businesses, and build wealth. But they've also concentrated enormous power in private hands. They've triggered repeated economic crises, often due to excessive risk-taking or fraud. They've been bailed out repeatedly by taxpayers while their executives got rich. This isn't a story of heroes or villains, it's more complex than that. Banks are powerful because we made them powerful. Every regulation, every bailout, every choice to prioritize stability over competition contributed to their dominance. As we look at American banking today, we must ask difficult questions. Is too big to fail acceptable in a democracy? When banks fail, should taxpayers bear the cost? When banks profit, do they share those gains fairly? Should 4 institutions control half of all banking assets? Is competition still possible, or have we accepted oligopoly? Can banks be trusted to self-regulate, or do we need fundamental reform? What does it mean that banks are now more profitable and powerful than before the worst financial crisis since the Great Depression? These aren't rhetorical questions. They're choices. The banking system we have today was built by choices made over 250 years, by politicians, regulators, bankers, and ordinary Americans. The banking system we'll have tomorrow will be built by our choices. Banks will tell you they're essential, that modern capitalism cannot function without powerful financial institutions. They're right. But democracy requires that no institution becomes more powerful than the people. For most of American history, that tension has defined banking, the need for financial power balanced against the danger of concentrating too much of it in private hands. Today, that balance feels out of kilter. The financial crisis proved that banks can hold the entire economy hostage. The bailouts prove they'll be saved when they fail. The scandals prove that accountability is limited. The consolidation proved that competition has nearly disappeared. We've built an empire of banks, institutions with global reach and extraordinary power over economic life. They've achieved what even J.P. Morgan, in his wildest dreams, could not have imagined. The question is no longer whether banks dominate America. They clearly do. The question is, what are we going to do about it? This is the rise of banks in America. An empire built over centuries. An ongoing story. One that isn't over yet.